Everyone is obsessed with building out LBO models. They spend all this time learning how to put together these massive Excel spreadsheet, tons of tabs, all these complex formulas, and they lose sight of why they're even doing an LBO model in the first place. And so an LBO model really is just trying to show you the price you can afford to pay. And a lot of people lose sight of that. So today in this video, we're going to spend about half an hour getting rid of all that shit and just focusing on answering that simple question of what you can afford to pay. So we're going to remove all the unnecessary crap. We're not going to build out a massively complex Excel model. We're just going to answer that question with a very straightforward case study. So let's jump straight into it. So we've got this project here. It is the 100% acquisition of Fern's Software Pty Limited. So this particular project here, I've got both the buy side and the sell side within it, so you can play on either side. For this one here, the buy side's more challenging because you need to calculate the exit price as well as the entry price. So we're going to do the buy side for this video. So this is just a case study from the program that I run. So what we need to do first is just read through this and understand the details. So skimming through it, I'll provide this document for you as well. But skimming through this, we've got an acquisition. It's structured as 50% equity, 50% debt, with no material debt pay down over the investment period. We've got primary function of entry price, EBITDA growth, exit valuation. Yep. So we're assuming a 5-year hold period, sustained growth, and no synergies with an expected IRR of 20%. All of that will come into play later on, and I'll show you that. So as we're going through it, we just want to, I'm just focusing on the final price and the valuation range. I'm not going to go through the adjustments here because I just want to concentrate on the LBO model. So just number one and number two for this, number one and number three. So as it says here, should take about 35 minutes for you to complete. So as we're reading through this, it's a SaaS provider. We've got a 92% revenue from recurring subscriptions with a revenue retention of roughly 104%. The reason why this is important is we're going to look at some comparables later on. And so we need to see how this business compares to public companies and private transactions as well. So going through it, we can see the company is growing year on year, both revenue and EBITDA wise. It looks like, from the view of this, it looks like it's growing in EBITDA percentage as well, but we'll take a look at that. We understand a bit of the cash flow and balance sheet there. Won't go into detail that. And then we've got the comparables here. We've got both public trading companies and private M&A transactions. The private transactions typically are a higher multiple because there's a control element to it, because you can control what the business is doing. Whereas looking at the public companies, you are buying a share in the company, you don't control how it operates, and so it's a bit of a discount to what you would expect in private markets. And that's why when you see a public company being taken private, usually it's at like a 30 to 40% premium to what it's trading at on the market. Depends on like how high demand that company is and whether it's trading in line with where it should be or whether it's already like been hammered in the public market. So that 30-40% is just a guide. It's not always around that range. But yeah, so we can see that we will see in a bit that public trading companies are at a bit of a discount. Cool. So that's a bit about that. So what we're going to do to start with is we understand enough about the business, read through this so you understand it as well. But now we're just going to compare the business to the comparables we have here. Not all of them will be relevant. And so let's take a look. So first I want to look at revenue growth and see where the revenue growth is for Project Fern, so Fern's Software. So first, let's get these financials into a Excel spreadsheet. Again, we're not doing a full-blown model, but we do need this to be able to calculate some of the things. So first, let's start with, we've got, just copy and paste this whole thing. Hopefully that works. That works fine, cool. So let's have a look at revenue growth. Nothing the first year. it's dropping off there, not unusual. Let's go EBITDA margin. We can do that in here. And then that's growing as well. So that's quite usual. Like, it's obviously a younger company there. It's not as stable. So it's growing quite heavily in these first few periods here, as you can see with the revenue growth. And then it stabilizes a bit in that final period. In that same growth period, you would expect that EBITDA margin is a bit lower because there's other costs in there associated with growing the business. And so that's starting to stabilize out here now. So we'll factor that into our assumptions later on. But that's good to know. So I'm not going to go into NPAT and EBIT percentage there, just because looking at the comparables, we've got an EV on revenue and EV on EBITDA. So I don't really care about the others for now, or for this particular case. So now we've got our growth there. So we've got 31 or 32, 30, 9.6. As I said, it's a growing company. It seems to have stabilized a bit. There's a lot of assumptions you can make around this. I'm going to just take the final period, so FY25. Let's just clean that up a little bit. FY25, I'm going to take that 9.6% rather than taking an average of the 3, which would have got me 24%. So let's take the 9.6. That's what I think is the continued growth going forward. So I think that this one is pretty comparable. This one's pretty comparable. This one's pushing it a little bit. I mean, it's double the growth, so let's just leave that out. Growth at scale, so these are the private ones. Again, this is 14%, reasonably comparable, 10% definitely comparable. Cool. Now let's take a look at the EBITDA margin. So it's growing. It's about 33%. It's hard to take like the 1 year and understand it. I know we did that with revenue. That's just because the previous years are completely uncomparable to where the business is at now. But now we've got 2 periods here where it's kind of stabilized, around that 30 to 33%. So the assumption I'm going to make there is that we'll take the 31. So at 31, we've got EBITDA. That's pretty close there. That's a good one. Good one there. We don't have that in here. So we don't have growth here. What we have is recurring revenue. And so recurring revenue, if we go back up, we have our, not 82%, it was 90 something, 98, I think. 92. 92% is recurring revenue. So having a look down here, very comparable. Pretty comparable. And let's take that top one as well. So that's reasonably close. 97 is pushing it a bit. It's about 5%. Could include it if you wanted to. A bit of an assumption there. So these are the ones I want to include. So let's get rid of the other ones that I don't want to include. And Comp D. So this now forms our valuation range for the companies. Again, we can see that if you look at these ranges here, so we've got 2.7 to 3.2 for the public companies, and the same EV revenue, we've got 3.1 to 4.8. So it is trading at that higher multiple as expected. So what I want to do is just quickly put that in here. So let's go the EV on revenue first. I'm going to go public, private. Let's go low, high, midpoint. I'm not doing a proper graph here. I just want to rush through this and show you how to calculate what the entry price should be, which is the final thing we calculate. So yeah, not doing this super neat, as you can see. I'm just going to push through. So here we've got a low of 2.7 on the EV, 2.7, high 3.2. So if you look at these ones that we've excluded, they are significantly higher. The reason for that is they've got really strong growth there. Bit of a difference in the EBITDA margin. So not quite comparable, but to be honest, like it's lower EBITDA margin, so you might be able to include something like that. But yeah, so you can see that picking the right companies does impact where your valuation will head. So now we're going through the range for the private companies. We've got 3.1 to 4.8. Sorry, just trying to type around this mic. So let's just go the average of the two to get the midpoint. Pretty straightforward. And now let's do the EV on. I said I wasn't going to clean this up. I'm going to a little bit. EV on EBITDA. Public, private. So public, we've got EV, EBITDA. We've got 10.5 to 11.5. Private, we've got 12.5 to 18. Pretty big range. Okay, so now we've got our ranges there. We want to understand where our exit valuation is going to come. And I know that sounds a bit counterintuitive, but you'll see why as we're going through it. So get to the exit valuation. It's a holding period of 5 years. So we need to forecast out this financial statements for 5 years. They've assumed no synergies. So if you go up here, sustained growth, no synergies, expected IRR of 20%. So in doing that, all I want to do is I'm just going to take that revenue growth and apply it out. So nothing too complicated. So let's just expand that out for 5 years. 3, 4, 5. Yeah, cool. Equals that. Let's just fix that one and we can drag that across. So now we've got our revenue growth through that period, and so we can use that exit value there to calculate our EV revenue to get the valuation range there. But we also need the EBITDA. And so EBITDA here, I want to take the average of these final 2 years, like I did in the comparables there. That's the expectation of where the company's heading long term. So just going to go equals the revenue times the average of these two here. Let's fix those in. What's that divided by 0? I fixed the wrong thing. Cool. So 7.92. So let's have a look at what our range now looks like. Just copy these down, but they'll be our ranges now. So low, high, midpoint. Again, not making this too tidy, just rushing through it for you. So public, simply just low times where we think our revenue's heading. Fix that one. Works, yeah. And then we can drag that down. Except that should, yeah, cool. So as we can see, private markets, higher multiple, higher valuation range. So let's do the same thing here. Drag that down to EBITDA and just copy that through. Okay, so a pretty broad range there. So we've got from about 68 all the way up to 142. Very, very broad range. For this one here, like we would understand and put that out in a graph if we were doing this in a full exercise. We've only got 35 minutes. What I would do in the first place is just put it together. have time at the back end, I'll put together a graph and explain more about why I've taken that certain valuation. But for here, I'm just having a look at it. Let's just take the average of these ones. We're sitting at 95.6. So let's just go exit val. $95.6. Okay, so now we've got the exit valuation. Now we need to understand the entry. And now you'll see why it was important that we started with the exit. So this is what the PE firm could expect to be able to get in the market when they look to exit the investment. The reason why we've got public and private is because they're the two exit opportunities for this particular company. Just because they're acquiring it through a M&A transaction that's private doesn't mean that's how they're going to exit. And so we've taken the average there, or we've at least considered the public comparables there as well. So now we've got that, we need to figure out what our multiple on invested capital is, so MOIC. We do that by using the IRR of 20%. So we've got IRR 20%. That's given to us in here, just here, 20% there. Now to get the multiple on invested capital, we just have to go 1 plus that to the power of the holding period. So basically that's saying that we're compounding that expected return of 20% each year over those 5 years. And by compounding it, we get roughly 2.5x whatever we invest. And remembering we're investing 50% equity and then using the 50% debt to then acquire the company. At the end of the transaction, the exit val is 95.6. And so portion of that will be debt that didn't grow or didn't shrink. It stayed exactly the same as it did at the entry, but there's the equity component there that did grow through that investment holding period. So just looking at it, if we assume that 100% of it was grown through, was done through equity, here's how we would work out our entry figure. So we've used all equity to be able to make the acquisition. There's no debt in there at the end. So our multiple on invested capital is pretty straightforward. We just go the exit val on top of the multiple on invested capital. So as we can see, if we entered in at 38.42, after 5 years, if we exited at 95.6, then we would have the multiple on invested capital of about 2.5. So basically, we've 2.5'd that investment there by exiting at that value. Now, as we said, we haven't entered with 100% equity. We've entered using 50% debt and 50% equity, and so we need to make that adjustment. When you use a split of equity and debt, the multiple on invested capital is magnified. And so you're getting a higher return there, and that's why private equity firms use the leverage buyout model, because they're getting better returns for their invested capital. So let's have a look at it. Let's look at the 50% here. I'm going to say that, let's say we're using that exact same entry price and split it into 50% equity and 50% debt, just to see what the MOIC looks like at the end of that. And I don't know if MOIC is the right pronunciation. Multiple on invested capital is what I always call it. So let's just go, we've got the equity, debt, make that 50% just to say it's clear. The assumptions that we're going at this one here. So 0.5 at that. Cool. So we've entered in, we've invested 19.21 and we have used debt of 19.21 as well. So let's see, then at the end of the period, we have our exit value of 95.6. We take away the debt value. It hasn't moved at all. So equity value at exit equals our exit val minus our debt. So that's how much is left in equity when we exit at 95.6. What is that as a multiple of this invested capital here? $3.97 or 98 there. So if you compare that, probably should have zoomed in. If you compare that to the 2.49, you can see that using the split of the equity and the debt gives us a way higher multiple on invested capital. But that's not the question. The question is we're trying to find the price that we would recommend approving for the buy side and when we would walk away. And so when we would walk away is the point that it is below that 20% IRR. This here is higher than that. So what we want to do is figure out what split, what entry price makes sense for us to get to that position. So let's just give a bit of space here. So entry, bit of a question mark at the moment. That's what we need to figure out. So the entry price, what we do is we've got, and then I'm going to put the formula on the screen now. So the formula for running through the equity side of things and figuring out what the entry price should be when you're using a split, it's not as straightforward as going through the 100% equity calculation there. So what you will see on your screen now is we've got P equals EV exit on top of MOIC times E plus 1 minus E. You'll see what each of those mean there. Okay, so let's actually calculate that. So we've got the EV exit. So we've got that one there on top of our expected return there, our multiple on invested capital of 2.49 times our equity split, which we haven't written down. So we'll just go 0.5 plus our 1 minus 0.5. Let's put that all in brackets there. So that's our expected entry price. So 54.81. So let's just double check to make sure we've done the formula correctly using the same thing here. So just copy and paste that down. We've got equity times the entry. That's the remainder. Push that up to, so that is our equity value at the exit, which is our exit value minus the debt here. And that gives us our 2.49. Just make sure that's calculating. Yeah, cool. So bang on. So we've got our entry price here is 54.81. Anything above that entry price, so if we just go 60, it drops us below what we need as our multiple on invested capital. So that's our walkaway value. When we go back here, our walkaway threshold is if it is above that 54.81, we are walking away from the investment. The other question here is what is the valuation range? We've done that up here, but we've done that with the exit value. And so now we just do the exact same thing for the entry value. So instead of recalculating it all, I'm just going to put this over here next to it. Let's move that. So we've got the exit one here. We actually need the entry value at that point, and we want the low there. So let's just push that through. Same here again. So we've got the exit. Let's push that to the entry, and then we've got the low there as well. So you can see here from the range, we've got from 43 up to 93. So there is a world where this works, where that 54.8 fits within that range, though it's tight. Looking at the private transactions, it doesn't fit in the EV range. It just fits within the revenue range there. So that is the range that we would expect, that's supported by the available financial data. Okay, and we'll make that nice and pretty if we had time, but rushing through it is the best thing to do in the first place so you can answer the question at least. And then now that we've got time, because this hasn't taken the full 35 minutes, I would go back, clean all this up, do the graphs, show all of that sort of thing. But yeah, that's why it's important to figure out the exit value first so we can understand exactly what our walkaway price is, and then we can quickly apply the same thing to today's numbers to figure out where that valuation range is at the moment. The reason why some private equity firms can offer higher prices than others is a mixture of their expected internal rate of return. So as we increase this, the multiple on invested capital also increases, which means that we are entering in at a lower price there. So 47, if we go down to 15, jumps to 63. So that's one factor. The other factor is synergies. So in this, as the details here say, we are assuming no synergies. So we're expecting that the business will just grow by that 9.6%. They'll stay at the same margins. There's nothing that's going to take place from the acquisition to the exit. So if there were synergies, that would lift both, well, it might lift the revenue, but it would certainly lift the EBITDA. The more it lifts the EBITDA, the higher valuation you're getting at the exit, so the higher multiple you're getting as well. So that's one other factor. And then the other thing is the assumption just on your growth and your EBITDA percentage. So if we decided to take an average there of 23.9, so let's go times average, those three. I should have made this more dynamic to be able to show you this, but it's all right. Why is that not working? Times 1 plus. So you can see we get a way higher EBITDA at the end of it and the valuation range. So we have a 176.63 at the end, much higher than that initial 95. I think it was 95. And so our entry can go all the way up to 101, and we'd easily be able to do that. Yeah, 95.6. So there's a couple of factors there, and that's why we have the different the valuations that are different between different private equity firms. But that's a quick way to calculate a very simple version of an LBO model. The LBO model, and the reason why that's more complicated, is that we have also assumed in here that there is no debt pay down, and so no material debt pay down. And that impacts things, because if you get to the end here and the debt has gone down to say 15, that increases your multiple as well. But yeah, hopefully that was helpful. Just wanted to go through it really quickly. That's an exercise that I do with people in the program. It is something that is on the more challenging end. I try to do it without having a big spreadsheet, but it's easier just to have an Excel there, just to put numbers, throw numbers into it. But you should be at a level where you're confident enough that you could do this with pen and paper and a calculator. But yeah, hope that was helpful. Practice it, do the sell side as well. Spend a bit more time on the entry price there. But yeah, that's how you do a very simple LBO.